numbers have been coming up, Vince. I think for a while we were thinking sub 2 was in the card.
6 weeks ago, everybody was talking about the recession of 2019.
Yeah.
It doesn't really feel that way. 2.5% growth in the first quarter is pretty impressive. It's stronger than the fourth quarter of last year. And for some reason or another, first quarters tend to come in soft. Like 7 out of the 8 last year's, the first quarter was terrible.
Right.
0.8% residual seasonal discount. So that's really a 3% growth if we get something like that. That's not a slowdown.
Are you at 2 3/4, or you say recent data has indicated 2 3/4?
Yeah, so if I had to write down a point forecast, and I don't much believe in point forecasts, it'd be 2.6.
And that includes the seasonality. And so some of this...
That's what they'll print.
That's what they'll print, but it's actually higher.
The underlying
that's already
would be growing in
that's into account.
3%.
I mean, that would be the best first quarter we've had in how many years?
It'll be a while, but the thing to remember is it's old news. This is late after the quarter, just like the earnings report are somewhat old news.
What does that mean, that second, third, and fourth are already going to reflect cost pressures or margin pressures?
That's our forecast.
So this could be the best of the year?
This would probably be the best of the year.
That's weird.
But that's the good news. The good news is 3% growth on an underlying basis isn't sustainable when the unemployment rate's 3.75%. And so some modest slowing from here is what makes the expansion sustainable.
Vince, yesterday we got earnings from 3M, and they showed a lot of weakness. They blamed a lack of demand in some of their end markets. But I think 4 of their 5 businesses had all that weakness. We had an analyst here on set with us, and he said he wasn't surprised by that he thought you'd be hearing things like that from a lot of the mid-level, small-level manufacturers that are providing to auto industry and other places.
Yeah, so there are 2 things to worry about. The number one is manufacturing hasn't come back. Part of the story might be that it's just a lag relative to China gearing back up. The other is the neighbors of China along the Asia-Pacific rim haven't also come back. So
that could be a lag effect too, right? Everybody kind of rides on China.
So the bet is it's both a lag. And
I feel like it's only been about 4 weeks since we saw a potential stabilization in China. Is that right?
Since we became confident about that. And what we keep hearing is they're throwing a lot of high-quality stimulus at the problem. Let's not talk about the medium or longer term of China and what that does to their balance sheet and risks. But previously, when Chinese officials want to deliver top-line growth, they deliver top-line growth.
So if we're down at 3 3/4, and we continue to have a fairly strong economy, then wages are going to continue to go up, in your view.
Right, and in our forecast, earnings growth is going to slow more than GDP growth.
Because of the
margin pressures. And besides, profits generally have a much higher cyclical amplitude than GDP.
Are we starting to see some easing of the inequality concerns based on finally the job market being so strong, or not?
Not so much in wages, more in participation. The jobs are out there, so there's a base for
that was my point, though. Participation is getting pretty tight, and we're going up as much as they can go. It's good, but if it's up as much as it's going to go, then sooner or later it's got to come in wages then, right?
Right, so the good news is if it's a cyclical margin squeeze, then it means workers are getting more.
Right.
The issue about inequality is which workers are
Look, all the billionaires that come on here are building walls around their houses, and they're talking, they're not walking the walk, but they're talking the talk about, they got a lot of guilt and look what this election is setting up to be. It's about higher taxes because of income inequality and the wealthy. Is it right that we're addressing this right as it's starting to ease?
Well, why don't you let's talk about the earnings reports we've gotten over the last couple of days. The big guys are getting bigger. They're increasing their market share. They're more concentrated.
So
Amazon is just
this is
bigger
an income
and bigger.
Inequality in the earnings we're seeing? Is that what you're saying? Or?
I'm saying it's an increase in concentration. An increase in concentration is
Which
associated
means small
with
businesses maybe aren't
doing as well,
and that translates into a big swath of Main Street America too.
Exactly.
Yeah.
So for the year we end, do we do 2.5%, which would be
2.5 is the point forecast. Yeah.
That's higher than the last 10-year average, right?
Higher than the last 10-year average. A pretty good accomplishment if you think trend growth is closer to 2%, because remember, demographics are destiny. Population growth is slowed. We're not generating as much output per hour. Maybe you could be a little bit more optimistic about productivity, but we're still probably going to end the year with more excess demand than when we started.
You don't make your money forecasting stock or bond prices, but
oh no, I'm the chief economist.
You do everything.
Strategist of
oh
the
my God, that's too much. That's too
Mellon,
much. The last thing I want to do is get my stock picks from an economist. But I'm going to give you. I don't know if I want anything from an economist. Really, but your point is that people assume the Fed's out, which may not be true as it comes back. They also haven't taken into account that earnings slow more quickly than the GDP does. Mm-hmm. So that's another. And
I assume the Fed's out of this. Am I
right?
Wrong
And then volatility will rise. So you say it's a triple whammy for stock and bond prices later in the year that they could have to be facing.
Right. So what it suggests is a couple of things. First is, how quickly did your opinion change in like about 6 weeks? As macro data changed, the Fed changed.
As the Fed
Why can't that happen again? And if the Fed can move that quickly, if it can pivot 180 degrees, in a blink of an eye, can't they do it again?
Except for that there's going to be a lot of pressure.
Sure.
The president's been putting pressure on this. I don't think anybody feels like we're out of the woods in terms of the economy. I feel like there's a lot of questions that are still out there.
Oh, Jay Powell's not going to be a hero. He's not going to be leading the pack and say, let's do this.
I don't see a Volcker
However,
moment.
if we get the forecast where inflation's coming back up a little bit, we see growth as high as it's been for a while, then Jay Powell doesn't have to lead. He just has to follow the markets who suddenly start saying, oh, maybe we're behind the curve. Maybe there's some inflation.
But it would be the market that would figure it out first, you think, and maybe sniff it out, and they would come along.
The whole thing about data dependence, decisions meeting by meeting, that's about letting markets move them. And markets will respond to the data. Data get better, markets will respond.
Good that could happen that would make your outlook become more bullish or make it seem that you're too bearish?
Yeah, you're right about
like China.
The outlook is basically.
What about China?
It's a first half, second half. This is risk on because the Fed's out of the frame.
But what if there's a trade deal? Is what I'm saying.
So I think the thing that would make me more bullish is no evidence of inflation at all. We get a China trade deal. We get some maybe some more appreciation of the dollar. We find out that oil prices are as high as they're going to get this year. Then the Fed can just sit on the sidelines. They're not going to ease, but they'll just sit there and they'll watch real interest rates be unchanged, and that will be a fuel to further financial accommodation. However, we might be talking about financial excesses at the end of the year. That's the risk.